Hello everyone, here is the answer to exercise 1 in unit 3 of AC201. In this exercise, we are going to have to figure out what we are going to classify certain accounts as on our classified balance sheet. We are Triumph Gaming Chairs Incorporated, and we have the following assets, liability, and equity accounts listed on our adjusted trial balance. We need to determine what classification we're going to put each account under from the list that we have here. We have current assets, which are assets that we expect to expend or convert into cash within the next year. We have long-term investments, which are investments, assets of a financial nature that we plan on having on our books for more than a year. We have property, plant, and equipment, that is physical production equipment, manufacturing facilities, buildings, etc., that we're going to use for more than a year. We have intangible assets. Those are assets that do not have a physical form but are going to help us be profitable in the future. Things like copyrights, patents, and trademarks. And then if an asset doesn't fit into any of those classifications, we're just going to call it other assets. For liabilities, we have two classes. They are current liabilities and long-term debt. What is the difference between those two? 1 year. If it's something you expect to pay off in full within the next year, you classify it as a current liability. If it's a outstanding loan, outstanding liability that you think is going to take you more than a year to pay off, then it gets classified as long-term debt. So that would be things like bank loans and mortgages and bonds. And then lastly, we have equity. And equity for our corporation here is going to come in two forms. The amount of money that was paid in from external parties, namely people that bought our stock, and the amount that we generated internally. So the amount of profitability that Triumph Gaming Chairs is going to retain. So let's start with our first account. It's cash. And like I said, current assets are things that our company expects to convert to cash within the next year. Well, cash is already cash, so it's going to be current assets. Next up, we have equity investments, and assuming that we're not super intent on selling this as fast as we possibly can, we're probably going to have it for more than a year, which means we're going to recognize it as long-term investment because it is an asset that is financial in nature. Accounts receivable, debt owed to our company from other people, well, we expect to collect within the next year, so we're going to classify that as current assets. And the next account, allowance for bad debt, is a contra account tied to accounts receivable. So it has to go in the same section that accounts receivable goes in. We're also going to classify that as a current asset. We have short-term notes payable. We took out a loan, but we're going to pay that loan off within the next year, which means it is going to be classified as a current liability. Salaries payable, I think our employees expect us to pay them within the next year, so that is also a current liability. After that, we have raw materials inventory. That is, inventory that we plan on using to create goods, in this case gaming chairs, that we can sell. Well, I think we expect to use any one piece of that within the next year, which means that has to be a current asset. Above, short-term notes payable was a current liability because we expect to pay it off within a year. Well, if it's long-term, it's going to take more than 1 year to pay off, which means we're going to put it into long-term debt. Retained earnings is the amount of profitability that our company is holding on to in order to expand operations, grow the business, and is therefore equity. Common stock is the amount of money paid in from external parties that can be attributable to the par value of our stock. That's still going to go into equity. PIK common, paid in capital in excess of par on common stock transactions, is the amount above that par value that people pay when they buy our stock, but that still goes into equity. Next up, we have WIP inventory, and again, that is inventory that we are working on, and I think we expect to finish completing that inventory within the next year, so we're going to classify that as a current asset. Next up, we have patents, which gives us exclusive rights to use certain technology when we make our gaming chairs. So maybe they have features that we have a patent on, and no one else is going to be able to use those same features. Well, that's an asset to us because it makes our chairs different from our competitors. But that asset, this patent, has no physical form. And it's not financial in nature, which means that you're going to have to classify it as an intangible asset. We have equipment, which pretty self-evident is going to go into property, plant, and equipment. We have accumulated depreciation of that equipment, and just like allowance for bad debt above, that is a contra account tied to another account, so you have to report it in the same section that the account that it's tied to appears. If equipment's going to go in PPE, accumulated depreciation of equipment also has to go into our property, plant, and equipment. Next up, we have our AOKI, our accumulated other comprehensive income, which is the amount of unrealized gain that we have on our books at the time from our investments or from currency translations or whatever. The thing is that is a form of equity, because if we did realize those gains, it would increase our income and therefore increase our retained earnings, so we have to report it in the same section that we report retained earnings. Deferred tax assets is next, and those are assets that stem from the prepayment or overpayment of taxes. So basically we have a credit online with the IRS because we either prepaid or overpaid our taxes at some point. And since that doesn't fit nicely in any of the other sections, we're going to call that an other asset. Accounts payable is amounts that we owe to other parties that stem from our normal business operations, like buying stuff from our vendor, our raw materials inventory, for example. Well, I think we have to pay that off within the next year, so that's going to be a current liability. Treasury stock is our own outstanding stock that we have bought back and now we hold on to. So we bought it back from the public at some point, but all stock accounts are always going to be listed under equity as long as they're not investments. Then we have HTM debt investments, held to maturity debt investments. We bought the bonds of another party, corporation probably. Well, bonds tend to be, years and years of length, 2 years, 5 years, 10 years, 20 years maybe. So those are long-term investments. Trademarks, just like patents, give us exclusive rights to use names, to have mascots, etc. Which means that's something we're going to use to increase our profitability in the future, but it has no form. It is an intangible asset. And lastly, we have finished goods inventory. Well, if raw materials inventory and WIP inventory were both classified as current assets, I think finished goods is going to go in that same section.